Okay, imagine a stock with a massive 40% market share in its home country, trading at incredible discounts, that has Wall Street absolutely drooling. If you're looking for international diversification, you've probably stumbled across this ticker at some point. But here's the twist that makes it one of the most fascinating companies to analyze right now. While analysts are practically screaming at you to buy it, the underlying financials might secretly terrify a legendary investor like Warren Buffett. Welcome to our explainer on Turkcell, Turkey's telecom giant. Today, we're going to tear down that glossy exterior and figure out if this company is a true golden opportunity or just a classic emerging market value trap where your US dollar might end up being the real victim. To really understand the sheer hype around this stock, look no further than the number 10. Right now, literally every single Wall Street analyst covering Turkcell, all 10 out of 10 of them, gives this stock a strong buy rating. I mean, they aren't just mildly optimistic here. They're predicting a massive 42% upside. It's incredibly rare to see this kind of unanimous conviction, a 100% agreement, especially when you're dealing with an emerging market stock. And, when you look at the surface level metrics, you can totally see exactly why they're so excited. The stock trades at roughly $5.60 on the New York Stock Exchange, giving it a market cap of about $4.5 billion. But look at these multiples for a second. We're talking a price-to-earnings ratio of 12.9x. That represents a 28% discount compared to its telecom peers. And a price-to-book ratio of just 0.8x. That's a whopping 54% discount. To put that into perspective, it essentially means the market is pricing the entire company for less than the value of its physical assets. It looks like an absolute deep value dream. But whenever a stock looks like the perfect value play and every single analyst is singing its praises, we have to pause and ask ourselves, what is Wall Street missing? Is it really that simple? Okay, let's dive into this. In this explainer, we're going to look way past the consensus and uncover the contrarian reality of this business. First things first, let's ground ourselves in the sheer scale of Turkcell's dominance. This is the largest mobile operator in Turkey, period. They boast 40 million subscribers and hold a commanding 41% market share. To put 40 million subscribers into perspective, that's literally more than the entire population of Canada. And it doesn't stop there. They've built this near monopoly when it comes to rural coverage, and their footprint extends way beyond just Turkey, spanning across northern Cyprus and Ukraine as well. They're an absolute juggernaut in their region. But to really understand this company, we need to enter the danger zone and aggressively tear down that glossy analyst facade. Section 1. The reality check. Hidden red flags. As we dig deeper into the numbers, we find this wild story of currency chaos and razor-thin margins. First up is what I like to call the illusion of growth. The company is guiding for 5 to 7% revenue growth for 2026. Now, on a standard earnings report, that sounds perfectly fine, right? But that completely ignores the reality on the ground. Turkey has chronic, sky-high inflation. They might be bringing in more lira, sure, but because the cost of everything in Turkey is skyrocketing at the exact same time, this business is effectively just treading water in real terms. Which leads us directly to the biggest structural threat of all, the currency time bomb, negative 15%. Turkcell reports its earnings in Turkish lira, but if you are a U.S. investor buying the stock on the New York Stock Exchange, you are entirely exposed to the wild, unpredictable swings of that currency. The company could successfully grow its local revenue by 10%, but if the lira drops 15% against the dollar, which, let's be honest, it has a historical habit of doing, you still lose money. This is a massive risk that Turkcell's management has absolutely zero control over, and it's exactly what scares off U.S. institutional money. Then we have the margin meltdown. Operating margins have basically been falling off a cliff, dropping from 20% down to just 15.5%. And the bottom line profit margin? It's sitting at a paltry 7.3%. Why is this happening? Because running a telecom is incredibly expensive. They're spending an absolute fortune on hardware sales, and they just had to write a staggering $653 million check to the government for their 5G license. That is a massive blow to their bottom line. All of those costs feed into what we can call the CapEx monster. Their capital expenditure intensity is sitting right around 25%. Think about that. That means a full quarter of every single dollar they make in revenue gets eaten up just to maintain and upgrade their existing network. That kind of relentless capital requirement completely crushes their free cash flow, leaving very little left over to reward you, the shareholder. So the absolutely crucial point here is what all of this does to the balance sheet. If you calculate the net current asset value, which is essentially the liquidation value of the company, it is literally negative. In the world of fundamental analysis, this is known as the Graham death sentence. They simply do not have enough liquid cash on hand to pay off the bills due over the next year. It's a huge red flag. However, despite all that doom and gloom, the balance sheet issues, and the currency risks, the bulls actually have an explosive counter-argument. Section 2. The hidden gem, green flags. Now, what's really interesting about this next part is that the bullish argument rests on a very solid foundation. First off, they have a deep, narrow moat. That incredible rural coverage means switching costs for local businesses are super high. Furthermore, they just secured 25% more 5G capacity than their main rival, giving them a real, tangible competitive advantage. But the true hidden gem here is their massive pivot. Turkcell is transforming from a traditional dumb pipe telecom into a high-growth tech player. Their digital business services, which includes things like cloud computing and data centers, skyrocketed by 64% year-over-year in the first quarter. This high-margin tech segment now makes up 12% of their total revenue. This is a huge deal because cloud computing and digital services bring in significantly higher margins than just selling basic cell service. At the exact same time, the quality of their customer base is absolutely booming. They just added 661,000 new postpaid subscribers, marking their best quarter for subscriber growth in 14 years. 81% of their base is now postpaid. These are the incredibly loyal, higher-spending customers that generate reliable, recurring revenue. It's a totally different ballgame than prepaid. But to truly understand why growth investors are obsessed with Turkcell right now, we need to talk about the legendary Peter Lynch metric, the PEG ratio. The PEG ratio compares a company's price-to-earnings ratio directly to its earnings growth rate. The golden rule here is that any stock with a PEG under 1.0 is considered significantly undervalued, simply because its growth is drastically outpacing its price. When we run those exact numbers for Turkcell, their PEG ratio sits at 0.32. Let that sink in for a second. 0.32. With an earnings per share compound annual growth rate of over 40%, a PEG of 0.32 is absurdly cheap. To a growth investor, a number like this alongside a successful tech pivot looks like an absolute grand slam. So how in the world do we reconcile a company that has a negative liquidation value but an off-the-charts growth valuation? Section 3. Clash of the Titans. To frame this ultimate face-off, let's put three of history's greatest investors, Benjamin Graham, Peter Lynch, and Warren Buffett, in the ring together to judge this highly conflicted stock. Let's see how this data creates a totally polarized consensus. First up, Benjamin Graham, the ultimate value investor. He would pass the stock on its low PE and PB ratios, but fail it instantly on that negative net current asset value we talked about. His verdict? A grade D. It's a mixed bag that smells heavily like a value trap. Then we have Peter Lynch, the growth guru. He'd look at that 0.32 PEG ratio, the 40% EPS growth, and the booming digital revenues and slap a strong buy on this. To him, the market is mispricing the risk, making it a perfect growth at a reasonable price play. And finally, we have Warren Buffett, the quality compounder, who would look at this whole situation and give it a very hard pass. And Buffett's rejection would be brutal and immediate. He would look right past the growth and see that Turkcell's gross margins are a razor-thin 0.3%. Actually, scratch that, not 30%, 0.3%. Remember that CapEx monster we discussed earlier? It has eaten away almost everything, and their return on invested capital is effectively 0%. Applying his philosophy, Buffett would argue this company has zero pricing power and that the intense telecom competition has eaten every scrap of their real profit. For Buffett, it's a definitive, unquestionable rejection. Which leaves us with a really difficult choice. Section 4, the final verdict. This explainer proves that Turkcell is a stock of extreme, unignorable contrasts. It's a company where every single data point seems to violently fight against the next one. The bottom line is this: if you buy this stock today, you aren't just buying a dominant telecom company pivoting into cloud computing. You are essentially taking a massive position on the Turkish lira. Management can execute flawlessly, but your fundamental success here as a foreign investor is tied entirely to trusting the stabilization of the broader Turkish economy. It really is the ultimate cognitive dissonance, right? On one hand, you have the opportunity to bet on an astonishingly cheap 0.32 PEG ratio and a company rapidly transforming its digital revenue. But on the other hand, you have to stomach the constant fear of an incredulously low 0.3% gross margin and a balance sheet that struggles to cover its liabilities. Emerging markets offer huge rewards, for sure, but they come with incredibly complex risks. The question isn't just whether Turkcell is a good business, it's whether the macroeconomic environment will actually allow that business to reward its shareholders over time. So, after seeing the hidden red and green flags laid out like this, we leave you with one final thought. Are you brave enough to buy the dip? Or is this a value trap you're staying far, far away from?